What if I told you that the imaginary line between Canada and the United States represents two completely different philosophies on how you should own your home? It's one of the biggest yet least talked about differences between our two countries. In the United States, the gold standard is the 30-year fixed rate mortgage. You can lock in your interest rate for 3 entire decades and essentially forget about it, giving you a level of financial predictability that is almost unparalleled. Meanwhile, in Canada, the vast majority of homeowners are on a completely different ride. They are often strapped into a system of 2, 3, or 5-year terms. This means every few years, they're thrown back to the negotiating table, forced to accept whatever interest rates the market is offering at that moment. It's a constant cycle of renewal and uncertainty. One path offers what seems like absolute security. The other offers potential savings and flexibility, but with a looming risk that can derail your entire financial future. So which one is actually better? Which system truly helps you build wealth, and which one just keeps you up at night? As someone who has navigated the complexities of North American real estate, I'm going to break down the huge, fundamental differences between these two mortgage worlds. This isn't just about numbers, it's about understanding the core beliefs about debt, risk, and security that shape these two very different paths to home ownership. By the end of this video, you will have a clear framework to decide which system is truly better for homeowners and your own financial well-being. All right, let's start with the single biggest difference. The one that defines everything else we're going to talk about. It's the concept of term versus amortization. Now, both Canadian and American mortgages have an amortization period. This is the total length of time it will take to pay off your entire loan, which is typically 25 or 30 years in both countries. If you make all your payments as scheduled for that duration, you'll be mortgage-free. The fundamental divide is the mortgage term. In the United States, the term and the amortization are almost always the same. When you get a 30-year fixed-rate mortgage, you are signing a contract that guarantees your interest rate and your payment for the full 30 years. As of late 2025, those rates have been in the mid 6% to low 7% range. Think of it as a financial marriage. You lock it in, and for better or for worse, you know exactly what your payment will be for the next 3 decades. It's the ultimate set it and forget it financial product, designed for maximum long-term predictability. Now, let's hop across the border into Canada. The picture could not be more different. While your amortization might be 25 years, your mortgage term will be much shorter, most commonly 5 years. Other options like 1 to 10-year terms also exist. This means your lender is only guaranteeing your interest rate for that short period. Think of the Canadian system as a series of short-term contracts. You have a 25-year-long journey to pay off your house, but every 5 years or so, you have a mandatory financial checkup. At the end of your term, your mortgage matures and you have to renew it. You are effectively forced to go back to your lender or shop for a new one and accept the interest rates that are available on that specific day. Your payment could go up, it could go down, or it could stay relatively the same. You are perpetually at the mercy of the interest rate cycle. Why does Canada do this? Why not offer the 30-year fixed mortgage that seems so popular and stable south of the border? It comes down to how the banking systems are structured and how they manage risk. The US has a massive, highly liquid market for mortgage-backed securities, supported by government-sponsored entities like Fannie Mae and Freddie Mac. This makes it easier and less risky for American lenders to offer long-term, locked-in rates. Canada's funding model is different. Lenders here protect themselves from long-term interest rate risk by keeping contract terms short. To offer a 30-year fixed rate in Canada would be so risky for a lender that they would have to price it at a significant premium, making it unattractive for most borrowers. So instead, the risk is transferred from the bank directly onto you, the homeowner, every time you have to renew. The Bank of Canada has noted that this structure makes the entire Canadian housing market and its households far more sensitive to changes in interest rates. This single structural difference, the 30-year term versus the 5-year renewal cycle, is the foundation upon which everything else is built. It dictates the level of risk you carry, the type of products available, and ultimately your psychological and financial experience as a homeowner. So, we've established that Canadian homeowners live on a renewal cycle. But within that cycle, there's another layer of choice and risk: the type of interest rate you select. This is where things can get even more complicated and, frankly, more dangerous. In both countries, you can generally choose between a fixed rate and a variable rate. A fixed rate is simple. Your interest rate is locked in for the duration of your term. In the US, that's often 30 years. In Canada, it's typically for your 5-year term. For instance, in late 2025, some of the best advertised 5-year fixed rates in Canada have been around 3.8% to 3.9%. You know your payment won't change for those 5 years, but you have no idea what rate you'll get at renewal. And then there's the variable rate. This is where the Canadian system introduces a unique and potentially hazardous product. A variable rate mortgage is tied to the lender's prime rate, which moves with the Bank of Canada's policy interest rate. When the Bank of Canada raises rates, your mortgage rate goes up. When they cut rates, it goes down. As of late 2025, some of the lowest available variable rates have been around 3.5% to 3.6%. This is where it gets critical. There are two main types of variable rate mortgages in Canada. The first has a variable payment, sometimes called an adjustable rate mortgage. If the prime rate goes up, your monthly payment immediately increases. This is painful for your cash flow, but at least you know you're still paying down your mortgage principal. The second, and a very common type, is the variable rate mortgage with a fixed payment. This is a product that has caused enormous stress for Canadians. With this mortgage, your monthly payment stays the same, even when the prime rate goes up. You might think that sounds great, but it's an illusion. What's changing behind the scenes is the allocation of that payment. As the interest rate rises, a larger portion of your fixed payment goes towards interest, and a smaller portion goes towards paying down your principal. This leads to a terrifying concept known as the trigger rate. The trigger rate is the point at which your interest rate has risen so high that your fixed monthly payment is only covering the interest. Not a single dollar is going towards paying down your loan. You're effectively renting money from the bank. If rates rise even further, you hit the trigger point, where your payment doesn't even cover all the interest, and the unpaid interest gets added back onto your mortgage balance. Your mortgage is now growing, not shrinking. This is called negative amortization. This isn't just a theory. During the rapid interest rate hikes of 2022 and 2023, the Bank of Canada confirmed that a huge number of Canadian homeowners with these products hit their trigger rates. They were making their payments every month, thinking they were getting ahead, but in reality, their mortgage debt was either stagnant or actively increasing. It's a wealth-destroying trap hidden in plain sight. The standard American 30-year fixed loan has no direct equivalent to this. Your payment is your payment. It never changes. While the US market has seen risky products in the past, like payment option ARMs, that could lead to negative amortization, they are not a feature of the mainstream mortgage landscape today. This is a massive point for security and peace of mind. The Canadian variable rate offers the potential for savings if rates fall, but it comes with a hidden risk that can be catastrophic for an unprepared homeowner. Now let's talk about flexibility. Life happens. You might get a big bonus and want to pay down your mortgage faster, or you might need to move for a new job. How easily can you change or get out of your mortgage contract? On this point, Canada often has a slight edge, but it comes with its own set of confusing rules. This is the world of prepayment privileges and penalties. In Canada, most mortgages come with some prepayment privileges. A common structure allows you to increase your regular payment by up to 20% each year, and also make a lump sum prepayment of up to 20% of the original mortgage amount annually without a penalty. This is a fantastic feature for homeowners who want to accelerate their mortgage payoff and save a fortune in interest. But what if you need to break your term entirely? Say, you sell your house 3 years into a 5-year fixed term. This is where you face a prepayment penalty. For a variable rate mortgage, the penalty is usually straightforward: 3 months worth of interest. It's predictable and often not too painful. For a fixed-rate mortgage, however, the penalty is typically the greater of 3 months' interest or a complex calculation called the interest rate differential, or IRD. The IRD is designed to compensate the lender for the interest they will lose because you are breaking the contract early. If interest rates have fallen since you got your mortgage, the IRD can be astronomically high, tens of thousands of dollars in some cases. It can be a golden handcuff, trapping you in your mortgage or forcing you to pay an enormous fee to get out. The Canadian system does offer a solution called porting, where you can take your existing mortgage rate, term, and balance with you to a new property. This is a great feature that can save you from paying a penalty, but it only works if you buy and sell within a certain time frame and stay with the same lender. Now, let's look at the US. The 30-year fixed mortgage landscape used to be littered with hefty prepayment penalties, but this has changed significantly. Today, the vast majority of standard, qualified mortgages do not have prepayment penalties. You can pay off extra, or pay off the entire loan by refinancing or selling at any time without a direct penalty from the lender. This gives American homeowners incredible freedom. If rates drop significantly, they can refinance their entire 30-year mortgage to a new, lower 30-year rate without facing a massive IRD calculation. This is precisely what millions of Americans did during the low-rate environment of 2020 and 2021, locking in historically low borrowing costs for decades. So who wins on flexibility? It's a mixed bag. Canada offers structured annual prepayment privileges that are excellent for disciplined savers. However, the penalty for breaking a fixed-term mortgage can be devastating. The US system offers less structured day-to-day prepayment, but provides enormous flexibility to refinance the entire loan when market conditions are favorable, without the fear of a crippling penalty. For major strategic moves, the US system is arguably more flexible. We're covering a lot of ground here. And if you're finding this breakdown of the two mortgage worlds useful, do me a favor and hit that like button. It takes just a second, but it makes a huge difference for the channel and tells me you want more breakdowns like this. Now, let's get to the one difference that can be worth a fortune over the life of your loan: taxes. This is perhaps the most straightforward yet financially impactful difference between the two systems. It's a fundamental benefit that American homeowners have, which is almost entirely absent in Canada. I'm talking about the mortgage interest deduction. In the United States, homeowners can sometimes deduct the interest they pay on their mortgage from their taxable income. As of 2025, this deduction is available on mortgage debt up to $750,000 for loans taken out after December 15, 2017. For loans from before that date, the limit is $1 million. But here's the crucial catch. To get this benefit, you have to itemize your deductions on your tax return. The 2017 tax law significantly increased the standard deduction, which means today, only a minority of households actually itemize. For many American homeowners, especially those with smaller mortgages, the mortgage interest deduction provides little to no benefit because they are better off taking the standard deduction. However, for those who do itemize, it remains a powerful incentive. Let's run a simple hypothetical example for someone who can benefit. Imagine a homeowner with a $500,000 mortgage at 6% interest. In the first year, they'll pay roughly $30,000 in interest. If they're in a 24% federal tax bracket and are able to itemize, deducting that $30,000 of interest from their income could save them about $7,200 in federal taxes for that year alone. Over a decade, that's a significant saving. Now let's look at Canada. For the average homeowner, the mortgage interest you pay on your principal residence is not deductible. Period. You get zero tax relief for it. The only major exceptions are if you use a portion of your home for a business or have a mortgage on an investment property, in which case the interest can become a deductible expense. There are also complex strategies some people use to convert their mortgage into a tax-deductible investment loan, but for the vast majority of people, the interest on the roof over your family's head is paid with after-tax dollars. This is a monumental difference in public policy. The US government offers a tax subsidy for homeownership to some of its citizens, whereas the Canadian government generally does not. When you ask which system is better, the mortgage interest deduction, even with its limitations, is a huge financial advantage that many Canadian homeowners simply do not have. So far, we've focused on what happens after you get the mortgage. But what does it take to get approved in the first place? Both countries have systems to manage the risk of lending to people with smaller down payments, but they go about it in different ways. In Canada, if you have a down payment of less than 20% of the home's purchase price, you are required by law to have mortgage default insurance. This insurance protects the lender, not you, in case you can't make your payments. The primary provider of this is the Canada Mortgage and Housing Corporation, CMHC, a government corporation. The cost is a premium that is usually just added on top of your mortgage principal. But here's the most important part of the Canadian system: the mortgage stress test. Every single borrower from a federally regulated lender, regardless of their down payment size, must pass this test. The stress test forces you to qualify for your mortgage not at the rate you're actually getting, but at a higher qualifying rate. This rate is set as your contract rate plus 2%, or a floor rate of 5.25%, whichever is higher. For instance, if you are offered a rate of 4.5%, your finances must prove you can afford the payments as if the rate were 6.5%. This was designed to ensure Canadians could handle their payments if rates were to rise significantly at renewal, a direct acknowledgement of the risk in the short-term system. Now for the US side. If you have a down payment of less than 20%, you will also typically be required to have insurance, but it's known as private mortgage insurance, or PMI. Instead of being a lump sum added to the mortgage, PMI is usually paid as a monthly premium. A key difference is that once your loan-to-value ratio reaches 78%, meaning you have 22% equity, the lender is legally required to automatically cancel the PMI, so it's a temporary cost. Crucially, the standard US mortgage application process does not include a national, mandatory stress test like Canada's. Lenders will, of course, assess your debt-to-income ratios to ensure you can afford the loan at the contract rate, but they don't typically force you to qualify at a hypothetical higher rate. This is because the risk of a payment shock is almost non-existent with a 30-year fixed loan. The result? It can sometimes be easier to qualify for a larger mortgage in the US than in Canada, even with the same income and down payment, simply because you don't have to clear the high bar of the stress test. The Canadian system is more paternalistic, building in a buffer against its own inherent renewal risk, while the American system relies on the long-term stability of the product itself. So, after breaking it all down, which system is truly better for homeowners? The Canadian mortgage with its flexibility and short-term renewal cycle, or the American mortgage with its ironclad 30-year stability? The answer isn't a simple one-size-fits-all declaration. The better system really depends on your personal financial philosophy, your tolerance for risk, and whether you value predictability over potential optimization. Here's my take. For peace of mind, financial security, and the ability to sleep soundly at night, the American 30-year fixed-rate mortgage is the undisputed champion. It eliminates the single biggest risk in a homeowner's financial life: interest rate risk. You know what your largest monthly expense will be for decades. This stability allows for precise long-term financial planning, budgeting, and investing. You are shielded from the volatility of bond markets and the decisions of central bankers. When you add in the potential benefit of the mortgage interest tax deduction for those who qualify, the case for the US system as a vehicle for steady wealth accumulation becomes incredibly strong. The Canadian system, in contrast, feels more like a high-wire act. It's a system built on a recurring bet. You're betting that when your 5-year term is up, interest rates will be in your favor. If you win that bet repeatedly, you can benefit from lower rates over time and use the prepayment privileges to get ahead. And yes, many Canadians have become mortgage-free faster by taking advantage of low rate periods. However, as recent years have shown, this bet can go horribly wrong. A huge wave of Canadian borrowers are facing renewal in 2025 and 2026 at rates dramatically higher than what they started with, leading to payment shocks and immense financial distress. The Canadian system forces you to be an active and often anxious participant in the financial markets. So, what is the verdict? In my opinion, the American system provides a clearer, more stable path to building wealth through homeownership. It is designed for security. The Canadian system offers a more volatile path. It provides tools for the financially savvy and risk-tolerant to potentially come out ahead. But it contains structural traps, like trigger rates and renewal shocks, that can severely punish the unprepared or the unlucky. It's designed for flexibility, but at the cost of security. Ultimately, homeownership should be a source of stability, not stress. While the Canadian system has some great flexible features, the profound security and potential tax advantages of the American 30-year fixed-rate mortgage make it, in my view, the superior framework for the average homeowner looking to build long-term wealth and security for their family. But that's my analysis. I want to know what you think. Are you a Canadian homeowner navigating the stress of renewals? Or an American enjoying the stability of a long-term fixed rate? Which system do you believe truly serves homeowners best? Drop your experiences and your opinions in the comments below. I read every single one. And if you want to master your personal finances and make smarter decisions about your money and real estate, make sure you hit that subscribe button and turn on notifications so you never miss a video. Thanks for watching.